Understanding financial statements is essential for investors, business owners, and professionals who want to make informed financial decisions. These reports provide valuable insights into a company's profitability, cash flow, assets, liabilities, and overall financial health. However, interpreting them correctly requires a solid understanding of key metrics and financial principles. Here are 10 essential tips to help you read financial statements like a pro. 1. Understand the 3 core financial statements. The income statement, balance sheet, and cash flow statement are the 3 main financial reports. The income statement shows revenue and expenses over a period. The balance sheet provides a snapshot of assets, liabilities, and equity, and the cash flow statement tracks how cash moves in and out of a company. 2. Analyze revenue and expenses on the income statement. Start by examining the top line, total revenue, and compare it with cost of goods sold, COGS, and operating expenses. This helps determine the gross profit margin and net profit margin, which indicate how efficiently a company turns revenue into profit. 3. Assess profitability with key ratios. Use financial ratios like gross profit margin, operating margin, and net profit margin to evaluate a company's profitability. A higher margin suggests strong financial performance, while a declining trend could indicate inefficiencies or increasing costs. 4. Examine assets, liabilities, and equity on the balance sheet. A balance sheet provides insight into what a company owns, assets, and owes, liabilities. Pay attention to the current ratio, current assets divided by current liabilities, which measures short-term liquidity, and the debt-to-equity ratio, which assesses financial leverage. 5. Track cash flow for financial stability. A profitable company can still struggle if it lacks cash flow. The cash flow statement is divided into operating, investing, and financing activities. Positive operating cash flow indicates a business is generating enough cash to sustain operations, while negative cash flow might signal trouble. 6. Compare year-over-year, YoY, and quarter-over-quarter, QoQ, performance. Review historical financial data to spot trends. Comparing financial statements across different time periods helps identify growth patterns, seasonal fluctuations, or potential financial red flags. 7. Identify non-recurring items and adjustments. Look for one-time gains or losses, such as asset sales, restructuring costs, or lawsuits. These items can distort profitability, so it's important to separate them from regular operating income to get a clearer picture of financial performance. 8. Watch for red flags in financial statements. Warning signs include declining revenue, increasing debt, shrinking profit margins, or inconsistent cash flow. Unusual changes in financial figures or excessive reliance on debt financing can indicate potential financial instability. 9. Understand earnings per share, EPS, and valuation metrics. If you're evaluating a public company, check earnings per share, EPS, price to earnings, P/E, ratio, and return on equity, ROE. These metrics help determine if a stock is overvalued, undervalued, or performing well compared to competitors. 10. Read the notes and management discussion and analysis, MD&A winking face. Financial statements often include footnotes and MD&A, sections that provide explanations about accounting methods, financial risks, and company strategies. These details can give deeper insight into a company's financial decisions and future outlook. Mastering financial statements allows you to make informed investment choices, assess a company's financial health, and improve business decision-making. By following these strategies, you can read financial statements with confidence and spot key insights like a pro.